Following on from our first workshop, Investing 101, which covered the mindset and mentality you should have when it comes to approaching your investing journey, today we'll dive into the actual investing process and answer some of the most common questions that we get, mostly around how do I actually go about choosing the investments that are right for me? Well, we've got you covered in today's InvestNow workshop, Portfolio Construction. On the agenda today, we'll first provide an overview of the InvestNow Investing Principles and focus in on 5 of those principles in particular, which largely shapes the portfolio construction process. We'll then go into how you can apply some of the valuable lessons from these principles into your investing journey before opening up for a Q&A at the end. So if you have any burning questions, please do fire them through in the chat box and we'll try and get through as many of them towards the end. Just for some housekeeping though, please note that everything that I will be discussing today is just for general information and educational purposes only. Neither I myself nor InvestNow provides any personalized financial advice. We are, however, strong advocates for it, and we actively promote the benefits of seeking personalized advice from qualified advisors. So with that out of the way, let's jump into the workshop then, shall we? And the first thing that we want to bring up again is the InvestNow's 10 investing principles. So these are our guiding principles that are intertwined in everything that we do that help guide Kiwi investors towards long-term investing success. Each of these 10 principles has an important investing lesson embedded into them. That is stuff that is so fundamental that it applies to a complete novice investor to someone that's very seasoned. Last workshop, we covered the foundational investment principles that shape the holistic approach to investing. And today we'll cover the most important principles that investors should keep in mind when designing an investment portfolio that would actually help you meet your goals. So these are codified in the 5 principles highlighted in the middle rows, which is to understand the risks, individual risk tolerance matters, asset allocation is almost everything, diversification is essential, and investment styles can be complementary. So let's dive into the first investing principle then, shall we? Which is to understand the risks. So the investment universe is so wide, and now more than ever, investors are faced with what seems like an endless stream of investment choice. So where do you start? Well, investors should really learn before leaping. So before rushing to put any money into an investment product, it's first important to understand the fundamental behavior of different investment types, including the risks involved, how risk is inherently linked to returns, and how much time impacts all of this. First and foremost, all investing involves some level of risk. It doesn't matter if it's the safest asset in existence or the most shady. When you invest your hard-earned money, you are always taking on some level of risk. So while all investments do come with some risk, the risk can vary substantially between investment asset classes, which reflects the inherent nature of more safe assets like cash deposits versus more volatile assets like stocks. With that in mind, given different assets come with varying degrees of risk, if an investment is more risky, then naturally, we as investors should expect greater returns for taking on some of that risk. Otherwise, if all investments offer the same level of returns, we'd all just naturally gravitate to the lowest risk ones. This is why you see quite a nice direct relationship between risk and reward. As you move up from less risky to more risky assets, so from stuff like cash to bonds to property to shares, the potential returns on offer increase directly. So how do you know how risky an investment is versus others then? Well, if you're dealing with regulated products such as managed PI funds, they'll all come with a product disclosure statement or a PDS. Look, I know everyone loves reading these things, right? But they actually have some handy information in there, specifically section 3 of the PDS, which will be a summary of your investment options. And that always includes a risk indicator rating between 1 and 7, which signifies just how volatile the fund's historic returns have been. Generally speaking, the greater the potential returns on offer, the greater the risk incurred, which increases the volatility of your investment performance or how much it can fluctuate and move up and down. Therefore, it also increases the potential that your investment is underwater or it's lost money. This is why PDSs also outline a minimum recommended investment timeframe for each fund, again found in section 3 of the PDS, alongside a summary of each investment itself, which generally provides guidance on how long you should be invested in the fund for, to account for the time an investment may need to recover from being underwater and achieve its overarching investment objective of generating returns. If the potential investment you're considering isn't a regulated one, which would come with investor protections like PDSs, money managers licensed by the Financial Markets Authority, then you should be very wary. There's a lot of unregulated investments out there, such as wholesale products, crypto products, that usually come with significantly more risk, not just from a volatility perspective in terms of how much the value of investment can fluctuate, but also the risk of losing your money altogether. I mean, just look at some of the investors caught up in the 10% per year stable returns promise from the Duval guys, right? Which is currently going through a receivership process. So definitely be wary of unregulated products. But overall, you need to really just understand the risk involved into any investment that you invest into, whether it's regulated or unregulated. Now that we understand a bit about the risks of investments in general, let's dive into the second investing principle, which is that individual risk tolerance matters. So when it comes to risk in investing, there are two sides of the equation. The first side is the risks inherent in investments themselves, which we just discussed in the previous principle, and the other side is the risk tolerance of the investors themselves. So just because an investment offers high returns and thus high risk doesn't necessarily mean that it's actually suitable for you as an investor if you don't have the correspondingly high risk tolerance to stomach the volatile ride. So this is why understanding your risk tolerance is so crucial when it comes to investing, as it one, helps you select appropriate investments. Understanding your risk tolerance will naturally narrow down the wide investment universe into only the handful of products that is actually suitable for your situation. Investing with your risk tolerance in mind will also help naturally align your investment product with your investment beliefs and constraints, such as your time horizon and your financial situation, as these are key inputs that go into working out what your risk tolerance are. Also, aligning your investment decisions with your risk tolerance will help immensely in staying the course towards your goals. As even amid any volatility you'll inevitably face as part of the investing journey, you can rest assured that you've actually done the heavy lifting beforehand and confirm that your investment is currently something that you can stomach and that you just need to stay the course to reach your financial goals. Compare this with an investor that didn't do any of the risk tolerance analysis, and they didn't keep that in mind. Anytime, an investment is a bit more volatile, then, they'll be a lot more tempted to run towards safe assets, or worse yet, potentially lose all their money by investing into a product that is way too risky for them. So how do you actually work out what your risk tolerance is? Well, your risk tolerance is a combination of your risk appetite, which is your attitude towards risk, and your risk capacity, which is your ability to take on risk. These are not the same thing. So you could have an investor that has a really big risk appetite and wants to take on every single high risk return out there. But if they don't actually have the ability to take on this risk, i.e. they don't have the necessary risk capacity, if it's low due to having, for example, very little discretionary income to invest or a very low, very short investment horizon, then the overall risk tolerance is going to be low despite having a high risk appetite. It also works the other way around as well. You can have a high risk capacity investor that actually has a low risk appetite because fundamentally they may be very uncomfortable as investors to see the investments fluctuate all the time. So therefore their risk tolerance will still be low despite having a high risk capacity. To determine your risk tolerance, you first need to understand both your risk appetite, which you can gauge by taking questionnaires, which is stuff like, how do you feel if your investment moved by X? How long are you investing for? And then after that, you can assess your risk capacity, which will be determined by your financial situation. Stuff like how much income can you actually contribute towards investments every week or month, and how long you actually, can invest for and what your goals are. Once you have a firm understanding of your risk tolerance, which represents your willingness and ability to take on risks, and you'll then actually be ready to start investing. So that brings us to our third investing principle, which is asset allocation is almost everything. So asset allocation, or the proportion of your investment portfolio dedicated to various underlying investment types or asset classes, is probably the single most impactful investment decision that you can make. This is because asset allocation drives around 90% of your returns over the long term and effectively makes or breaks whether you achieve your investment goals or not. A simple analogy is that investing is kind of like the weather. If you had a goal to relocate to a new city and you preferred sunny, dry weather, how would you actually go about picking a city and a home in a place that you actually enjoy? Just checking that day's weather won't tell you much because weather can fluctuate all the time. So to know whether a certain location actually meets your needs, you need to understand more about its overall climate. So asset classes are kind of like the climate, while the performance of those asset classes is more like the 5-day weather forecast. So just like it's not a great idea to base your relocation on a current run of nice weather in a random city, choosing investments on a whim or chasing short-term performance is unlikely to be a winning strategy over the long term. Different asset classes tend to act in specific ways, kind of like the investing climate that they inhibit. By choosing which asset class you invest in, you have a certain amount of control over the experience that you'll have as an investor. There's no best asset allocation though, just like there's no best or perfect climate for everyone. It all really depends on what makes you comfortable and what gives you the best shot at meeting your goals. So let's understand what the climate is like for some of the three main asset classes that most investors will deal with. So first you have cash and the cash equivalent asset class. These are your term deposits, saving accounts. These are your safest type of investments out there. It's a vital asset class for investors that need access to their funds in the short term. But because it's low risk, it also comes with low returns. So investing most of your portfolio in cash is probably not going to result in much growth if your objective is, for example, a healthy nest egg at retirement. Next, you have your fixed interest asset class or your bonds. These provide higher returns than cash, but also come with slightly more risk. A key characteristic of bonds is that investors favor the stability of returns and the ability to preserve capital, which can help minimize a lot of the volatility involved with investing. Bonds typically don't provide the same level of returns as stocks, however, which is the final major asset class and offers the highest potential for returns, but also the highest amount of risk, as we learned. Nevertheless, having a sufficient amount of stocks in your portfolio is critical for those investors that are seeking to multiply their wealth over the long term. So now that we kind of understand the dynamics of these major asset classes, you can see why different weightings to each can result in vastly different investment outcomes. That's why it's really important to emphasize that there is no best asset allocation. It really just depends on your individual goals, risk tolerance, and time horizon. I realize it's probably not a very helpful answer for those that came here looking for a definitive answer on what fund they should invest in today. But again, we unfortunately can't provide financial advice, and it really does depend on your individual circumstances. But what we can provide is probably some general kind of rules of thumb or helpful hints. So, and it's really worth noting that as investors age and their risk tolerance naturally declines, they will transition from more growth assets like shares to more income assets like bonds and cash. So some general rules of thumb that may be helpful as a starting point to kind of work out what an appropriate asset allocation for you is the rule of 100. So this is where investors hold a percentage of stocks in their portfolio equal to 100 minus their age. So if you're age 65, for example, just hit retirement, then your portfolio should still be give or take around 35% invested in stocks. The other kind of nice rule of thumb is life cycle funds, which are a handy kind of guidepost. So this is similar in principle to the rule of 100. The only difference is life cycle funds would automatically replace at kind of preset age intervals and milestones the amount of growth assets you have in your portfolio with more income assets to reflect, your declining risk tolerance. It's important to really stress, however, that these are just guideposts and ultimately depends on your situation and risk tolerance, what your asset allocation might look like. For me, for example, the rule of 100 would say that I should be roughly around 70% in stocks, but my portfolio is closer to 100% in stocks, just due to the fact that I want to accumulate as much as possible and maximize my retirement nest egg. And I have a multi-decade investment horizon, so I'm quite comfortable to ride out that volatility. So my risk tolerance is quite high, so therefore I'm happy to load up on stocks. So now that we kind of understand the basics of asset allocation, a related but also important principle to discuss next is diversification, which is very essential to your investing success. Diversification at its core is a pretty simple concept. It's a risk management tool that codifies the age-old wisdom to not put all your eggs in one basket. Diversification will help you avoid catastrophic losses if disaster does happen to strike one day in terms of any single investment that you're exposed to. And there are plenty of reasons why an investment could lose significant value or potentially even go under, whether it's due to mismanagement of the company, not adapting to competition, fraud, natural disasters, just to name a few. Look no further than Kiwi success stories like Allbirds Shoes, which is down 98% since its IPO due to poor business management, or classic bankrupting stories like Enron and Lehman Brothers. So to avoid these risks, you want to diversify and spread your money across a breadth of investments, both across asset classes, such as your classic cash, bonds, stocks, but also stuff like property and commodities, as well as within asset classes. So within your share asset class, for example, you could diversify across different sectors or industries. You would diversify across geographies by investing both domestically and internationally, for example. Seeing how professional fund managers diversify their investments is a helpful guide to just how diversified you should be, with most managers diversified like kind of conservative, balanced, and growth funds having somewhere between hundreds, if not thousands, of underlying investments in them. But avoiding a disaster isn't the only benefit of diversification. By being diversified across asset classes, industries, and geographies, the returns you achieve will also be a lot less volatile, and this can help you better achieve your investment goals. This is because markets tend to be cyclical. So the economic environment is always changing, and some industries or assets tend to do better in certain environments and poor in others. So this is best shown in this kind of graph here, which ranks from top to bottom, the best and worst performing asset class in each year throughout the last 20 years or so. So it may be a little hard to read, but each square effectively represents one different type of investment or asset class, from bonds to cash to stocks to property. And the key thing to know is just how much of a patchwork it is. Every single year, it's basically different winners and losers when it comes to investments. So it just shows how hard it is to pick, consistently high winners. Just look at the last 2 years, for example. So in 2022, where commodities was first and large growth stocks was last, returning negative 30%. Just 12 months later in 2023, they've completely flipped around. Large cap growth stocks returned 43%, commodities came last. So trying to chase performance and investing into the best performing investments each year would be a disaster by just sticking to, and if you just stick to one asset type, for example, that can still lead to a lot of volatility. Just look at, the international stocks in red there. You can see it's kind of seesaws year to year, right? And, if we contrast this though to a diversified portfolio, which is your black squares, you can see that the investments for diversified are very, very smooth. And it's always middle ground. So it never gets too high and never gets too low, but that's the benefit of diversification. You have that reduced volatility. So the benefits of the reduced volatility is really twofold. So one, it provides for a much easier and smoother emotional investing journey. So if you're an investor, you're not constantly worried about whether your investment is going to strike disaster if it fluctuates all the time. And the fact that it's a lot more smoother will make it a lot easier to help you stay the course and just continue regularly investing. The other main benefit of a less volatile or smooth diversified investment experience is that oftentimes slow and steady wins the race. So the chart here provides a simple illustration. We've got two portfolios. Portfolio one is diversified across investments and offers a stable return of 10% in both years 1 and 2. Our portfolio 2 is concentrated and volatile returns, up 40% in year 1, down 40% in year 2. So if you did a simple arithmetic average, both portfolios, you'll find that both return 10% over the 2 years, right? Up 40, down 20, so up 20 altogether, so divide by 2, 10%. But that's not the way that investment portfolios work when you're calculating, the compounded returns. So you have to use a compound average return. And in this case, that's where portfolios 2 case, you're actually worse off, because losing 20% year 2 isn't losing 20% on the original 100K, using 20% on the increased 140K portfolio, which results in a 28K loss in year 2, and ends up with portfolio 1 being slightly better, returning 10% annualized versus under 6% for portfolio 2. So diversification is not just about avoiding losses, but can also help you bolster returns and kind of keep you on track towards your investing journey. The final principle is pretty straightforward. It's almost an extension of the diversification principle, and simply highlights that while there are so many different investment approaches out there, they all potentially have a place in your portfolio, and depending on your individual goals and constraints and values, investment styles can be complementary. So really all we're highlighting here is that professional investment managers all have their own specializations. You have kind of growth specialization managers, value managers, ethical managers. At the end of the day, each manager has a specialization, and there is no best way to invest. All these different styles can coexist. It just depends what's best to achieve your investment goals. So here we're simply highlighting that a couple of the major investment approaches include passive investing, which is your low-cost index tracking method; active, which involves trying to beat a benchmark; or ESG, or responsible investing, which aims to reflect non-financial goals like reducing carbon or kind of reducing exposure to sin industries like alcohol, tobacco. So these can all coexist. A good example is the Foundation series, Balanced and Growth Funds. So they use passive investing for their stock exposure, but then they use active investing for their bond exposure. So, and we're also looking to explore potentially adding an ESG lens to the Foundation series as well to kind of minimize exposure to stuff like alcohol, tobacco, gambling, et cetera, et cetera. So they can all kind of coexist. So to kind of wrap up then, how do you go about applying this all to your investing journey? Well, when you're next constructing or reviewing your investment portfolio, it should be done with 5 key principles in mind. So first, understanding the risks involved. We all know investing comes with risks. So when researching or reviewing investments, check the latest risk indicators and investment timeframes outlined in section 3 of the PDS to help quantify some of the risks involved. And as a reminder, risk and return should be directly linked. So checking to see if this aligns with some of the longer term historical returns of the fund or benchmark can be helpful as well. InvestNow has handily summarized a lot of these kind of key risk and return information on our website, in both the managed fund selectors page as well as the individual landing pages on each manager, which we can provide a link to after this. After understanding the risks involved with the investments themselves, the next important thing is to ensure that it aligns with your own risk tolerance. So remember, investors should always invest with their risk tolerance in mind, as otherwise you could be taking on too much risk that you can't afford to lose or stomach, or conversely, you could be taking on too little risk that you end up not achieving your investment goals. A good starting point would be to use a risk profile tool, which both Sorted and InvestNow provide, and it's effectively a questionnaire that helps you understand how much risk you're able to take. Now that you understand the risks involved, the third thing is, and arguably the most important thing, is to set your asset allocation, or what percentage of your portfolio will be invested towards the major asset classes like stocks and bonds and cash. Again, this should reflect your risk tolerance, but if you needed like a helpful starting point on what an appropriate asset allocation is, consider the rules of thumb like the rule of 100 or life cycle funds. Or equally, if you follow the risk profile tools and questionnaires offered by InvestNow and Sorted, it would spit out which category investor you fall into, from defensive to conservative to balanced and growth and aggressive, which conveniently line up with the diversified fund options that managers offer to investors as well, which effectively is just a preset allocation to growth and income assets, depending on what kind of risk and returns they're trying to target. Once you've landed on your appropriate asset allocation, which typically would already be diversified across asset classes, then next thing to keep in mind is to ensure that you also diversified within asset classes as well. So whether it's stocks and bonds or property, there are plenty of investment options out there across different sectors, countries, and styles. Again, seeing how professional fund managers manage your diversified funds is a good reference point. So Foundation Series Growth Fund, for example, has thousands of securities in there. So we're consistently diversified to make sure that no one security going bust is going to impact the portfolio. And finally, as part of the holistic portfolio planning and diversification process, it's also worth considering whether you want to incorporate different investment styles in your portfolio. So whether it's growth, value, passive, active, there are so many investment styles out there and specialties in the world which can happily coexist in a portfolio depending on your needs. A common one that many investors consider these days is an ethical and ESG investing, which can often be paired with an active or passive approach. Again, the key thing to consider, and this is really throughout the portfolio construction process, so if you learn nothing else except this, so when you're constructing a portfolio, always consider whether it aligns with your individual investment goals, constraints, and values. So that brings us to the end of our prepared remarks. So super happy to take any questions that anyone has. So please do fire them through to the chat box and we'll try and get through as many as we can. So let's have a look. Quick question. I missed the explanation of Rule of 100. Could you please provide a specific example? Yep. Okay. So Rule of 100, pretty straightforward. So effectively, what it says is that as a rule of thumb, your asset allocation or your percentage of your portfolio exposed to stocks or the more risky part of your portfolio that also provides higher returns should be somewhere in the region of basically taking 100 minus your age. So if you're age 65, then 100 minus 65 is 35. So your portfolio should be roughly 35% in stocks when you're age 65. Once you get to age 70, then your portfolio should be roughly 30% in stocks. So again, it's just a rule of thumb. So it would really depend on your individual risk tolerance and your individual situation. So you could be someone at age 65 that has, another 2 or 3 decades to invest because you want to try and maximize your nest egg as much as possible. And you don't need to tap into your retirement savings just yet. So you could realistically have a lot higher proportion of your investments in stocks because you want to try and accumulate as much as possible. Equally, you could have a 65-year-old, even a 50-year-old that, doesn't have much left in terms of their working career and wants to tap into their nest eggs earlier, then they might have a lower proportion in stocks relative to what the rule of 100 would say, because that's what their investment goals and constraints dictate. So again, it's just a rule of thumb, and you need to really just apply your layer of individual personal circumstances to it. But as a general rule, it gives you a good idea of what an appropriate starting point would be, which in general, if you're younger, you want to load up on kind of growth assets like stocks and property. And if you're older, you need to start using your nest egg, then you want to transition it to more income-oriented assets like cash and bonds, because you don't want the fluctuation when you need to use the money. Cool. Next question. What is the difference between sectors diversified and Australasian equities? Yeah, so a diversified fund is essentially a fund that is invested across different asset classes or sectors. So typically a diversified fund from your standard managers like your, Milfords, Fisher, Smart Shares, which has become Smart these days, Foundation Series, they invested across the key investment asset classes, which is your Australasian equities, which is basically your New Zealand and Aussie equities, international equities, so everything non-Aussie and New Zealand. You've also got local fixed interests, you've got international fixed interests, you've got cash, and you've got a lot of funds also include property and potentially some other stuff like alternative investments like hedge funds or direct property. So effectively, a diversified fund would be exposed to all those different asset classes, whereas an Australasian equities fund would purely just be investing in Aussie and New Zealand stocks. So it's quite a different risk profile. So in a diversified fund, depending on which level you go, because obviously diversified funds come in different kind of risk profiles. You have your conservative ones, balanced, growth, high growth. Generally speaking, a pure equities fund like an Australian equities fund will be right on the high risk spectrum because they're all invested in stocks. And as we learned, stocks can fluctuate quite significantly. But potentially, if you're a long-term investor, they could both be welcome additions to your portfolio. Again, depends on your individual situation. Okay, next question. What is the impact of tax for an NZ investor on investing in an NZX index fund versus an international share index fund? Yeah, that's a great question. So it probably goes into a bit more around tax and how to optimize and minimize fees and costs, which is something that we'll discuss in our follow-up workshop, which is on portfolio optimization. But I'm super happy to kind of touch on it here. So effectively, for a New Zealand investor investing into a NZX fund, typically this would be done within a PI fund. The way that a PI fund is taxed for New Zealand investors is that for local equities, so NZ equities, as well as a handful of Australian equities, the tax treatment for those shares would just be limited to any dividends that you receive. So just purely on the income. And then there's no capital gains tax once it's in a PI fund. So that's kind of the benefit of it. Contrast this with an international share index fund. Again, assuming it's a PI fund, they have separate kind of tax rules that apply to international shares. So it's what we call the foreign investment fund tax rules. So effectively what they say is that your taxable income is deemed as 5% of your portfolio value each year. So if your international share fund returned, let's say, 20%, you would only ever get taxed on 5% of it when you're in a PI fund. So, or equally, if it's returned negative 10%, you'll still get taxed at 5% of your return. So that's just a little quirk of how international shares are taxed within a PI fund. If it's not in a PI fund, say it's in an Aussie unit trust or it's an offshore ETF, then the fifth tax rules or the foreign investment fund tax rules are quite different. So you can either choose to apply that 5% rule in there as well. So generally speaking, if you made more than 5% returns, you'll want to just maximize your tax and just go for the 5% method, which is called the fair dividend rate or FDR method. Or conversely, you can choose the CV method for your fifth tax obligation, and it purely works out what your actual gain or loss was for the year. So if your gain or loss was less than 5%, let's say you only gained 3%, then you'll probably want to choose the CV method for your tax because then you're minimizing how much you actually pay. So that's a little overview on tax. And again, we'll kind of dive into it a bit more in the next workshop. So if that's of interest, do watch the space. Cool. Next question. I'm just conscious of time as well, so try and get through as many as we can. So isn't there a danger of adjusting too much when economic conditions have changed, given that fund managers will be making those changes as well? It could be counterproductive. Yeah, that's a great point. So it's definitely an element of where you can be kind of too diversified or too much tinkering with your portfolio. So obviously, fund managers would take the direct approach, or especially if you have an active manager, they'll manage your portfolio for you. So they'll do stuff like rebalancing, they'll buy and sell equities as they see value. If economic conditions change, and generally they would have already kind of shifted their portfolio asset allocation, assuming they are active manager. Less so for a passive manager, they'll just buy whatever is in the index, but indexes usually get rebalanced anyway, usually every quarter, just depending on how funds have performed as well. So there is a danger of, if you're constantly changing your asset mix, basically every single year, then it's probably not a great idea, because realistically, your asset mix shouldn't change. Your asset allocation is something that, again, is reflective of your risk tolerance, right? So your risk tolerance shouldn't change year to year, because there's the stuff that only changes when you have kind of major life events. So for example, if you bought a house recently, then all of a sudden you no longer need the security of the deposit to be there. You can take on a bit more risk. So all of a sudden, your risk tolerance has improved, and then all of a sudden you would be able to change your investment strategy. But if nothing's changed and you're basically from age 30 to age 60 just accumulating investments, it should be pretty static for the most part. Obviously, you would want to rebalance every year, but rebalancing is quite different to kind of reconstituting your asset allocation. So yeah, definitely be wary of trying to tinker around it too much. A lot of the best investment advice that I've received is just almost set and forget type approach. So that's why KiwiSaver has done so well. It's almost people just choose a fund, just keep contributing to it, and then all of a sudden it's a healthy nest egg when they retire. Cool. Probably just time for one last question. So here, you mentioned that with high tolerance for return and a long time span, one could prefer to invest large percentage of growth assets like stocks for possibility of higher return. But you also mentioned that high volatility derive less return due to compounding interest. So how do you recommend reconciling these two principles to make investment decisions? Yeah, that's actually a really good question. So yeah, there was almost two different examples there. So effectively, high tolerance for return would mean you are more inclined to invest into high risk assets, like stocks, for example, that have a high return. But if your assets are too volatile, then it could potentially impact your returns, like in that little chart that I had there. So I think the key difference there is in that chart, it's almost assuming that you're only invested into one asset class versus being exposed to a whole lot. So it's almost, if you were to only invest into stocks, right? So let's say, for example, you're only investing into emerging market stocks, which tends to be or small cap stocks, which tends to be a little bit more volatile. So if you're someone that could stomach the volatility, then potentially you have a lot to gain out of it. But if you're someone that cannot, and you'll end up potentially wanting to chop and change when you see a bit of volatility, then that would go against your kind of investment risk tolerance, and it'll go against the investment goal that you're setting out to achieve. So if you're effectively someone that can actually ride out the volatility, then investing into high risk stocks is a way to probably maximize your investment portfolio. Look, no one has a crystal ball, and we don't know if small cap stocks, emerging market stocks, or stocks in general are going to continue to outperform, but history says that it's most likely going to be the case. But if you're someone that's kind of trembles and wobbles a bit when you see a little bit of volatility, that's where the benefits of diversified funds apply. So in the return example, it may not apply every single year, but I think the most important thing that diversified funds provide is just that emotional rigor to be like, okay, great, I'm not seeing massive swings year to year. I'm seeing a nice consistent 10% return. So although you may not receive the same end outcome long term as a small cap investor, you probably would still be very well on your way to achieving your investment goal by just kind of being slow and steady. So it's just almost different strokes for different folks. Everyone's got different risk tolerance. It's just being really mindful of what you think your risk tolerance is and what it actually is. And you almost don't know until you start putting some money in there. And once you see a decent amount and you see it potentially fluctuating quite a lot, then investors act quite differently. So yeah, great question. Hopefully that wasn't too confusing and answered most of it. Unfortunately, that's about all the time we have left. If you guys do have any further questions, then please do feel free to send it through, and our team will try and answer as many of them as possible. As I mentioned, the next workshop is going to be on portfolio optimization, so do stay tuned for that. Otherwise, if you want to check out more about the InvestNow Investing Principles, check out, just Google InvestNow Investing Principles and kind of apply it to your investing journey today. So thanks everyone for your time today, and we'll catch you next time.